Hi Stackers. Today I'm going to break down why the $2 trillion private credit market is now on fire. But before I get into it, let's talk about what private credit actually is. After the 2008 Great Financial Crisis, banking regulators forced traditional banks to tighten their lending standards. That meant a lot of mid-sized companies couldn't get loans from a normal bank anymore. So private credit firms stepped in to fill this gap. These shadow banks raise money from investors and then lend it out to companies that are considered too risky for traditional banks. For years, this industry boomed. But a few weeks ago, the shadow bank Blue Owl Capital stopped allowing investors to take money out of one of its funds until they could raise more money. In other words, they had run out. Then the shadow bank Market Financial Solutions imploded after it was discovered just a few days ago that the firm had been using the same properties as collateral for multiple loans. Finally, last week, the stress spread to two industry giants, BlackRock and Blackstone. If you're not familiar with them, Blackstone is one of the largest private equity firms in the world. They buy companies and real estate and often act as the lender, owner, and manager all at the same time. BlackRock, on the other hand, built its empire managing index funds, but in late 2024, they pivoted a little and purchased HPS and their fund called the Corporate Lending Fund. This fund collects money from investors and then lends it out, mostly to software and technology companies, and often at very high interest rates. But recently, there have been serious concerns that AI will start disrupting many of the software companies in these portfolios. Not only that, but with rising geopolitical tensions and fears that the private credit lending market was struggling, both BlackRock and Blackstone were hit with about $1.2 billion in withdrawal requests. In response, BlackRock enforced their 5% quarterly withdrawal limit, which meant that many investors were unable to get their money out. Blackstone, on the other hand, temporarily raised their limit from 5 to 7% and even injected $400 million of their own capital to make sure that every investor who wanted out could get paid. Okay, yes, this move did help calm investors, but it also shows how much effort is required now to keep the private credit system looking stable. As we move throughout the rest of the year, we're likely to see smaller niche private credit lenders, especially those heavily exposed to AI vulnerable software companies or struggling commercial real estate, either collapse or get absorbed by the larger private equity firms. As investors begin to realize that their money may not be as safe as they thought, many of them will start looking to invest in assets that can't be gated, frozen, or restricted. Assets like gold and silver. While the price of silver may move up and down in the short term, industrial demand is rising, supplies are tight, and the investors who will soon be fleeing the struggling private credit market will eventually drive demand for silver up even more. So what should you do? Well, keep stacking as you can afford to and stay patient. I suspect that by early to mid-summer, we may see silver finally get the credit that it's due.